Well, the major indices slightly lower today as investors are bracing for the next round of corporate earnings, which begin with a wave of releases from big banks. They include Citigroup, J.P. Morgan, Bank of America. They all traded down today, in part to a downgrade that sent Goldman Sachs lower, but also as anxiety builds ahead of this earnings news. There are three reasons why investors are worried this earnings season. Number one, the latest round of earnings were amazing. 73% in the second quarter beat earnings, and yet the knee-jerk reaction was to sell. In fact, it was the first time since 2011 that earnings beats were generally greeted with stocks moving lower. Now, I think stocks nosediving on good news is actually good news, because it removes the notion of blind enthusiasm or irrational exuberance. The second concern going into the earnings season are lowered expectations. Now, at the end of the second quarter, we're talking June 30th, the blended third quarter earnings model for the street was 7.5%. It came down to 5% about a month ago. Now it's 2.8%. I'm confident earnings will come in significantly better than expected. And more importantly, though, we're going to continue to see year-over-year improvement in revenue and earnings. That is a key. And the third thing people are concerned about, valuations, right? The popular price-to-earnings valuation metric. I'll tell you something. It's probably cost more investors money than anything else. When the S&P forward PE ratio gets in the mid-20s for me, that's going to be a red flag. Here's the thing. As long as the fundamentals continue to improve, I'm okay with a higher PE. Now, I can see that the rally needs strong results and more confident guidance to justify where we are, but anyone that's missed this rally because of headlines over PE ratios, well, guess what? You've missed trillions of dollars in valuations that have been added to our market.